Welcome to Tech Talk Tuesday. I'm your host, Carla, and with me is my fellow co-host and CMT, David Blake. It's September 23rd, 2024, and it was a pretty solid week in the stock market last week. We have some important things to look at moving forward. We do it mostly from a technical perspective. David, I hope you had a great weekend. How are you doing today?
I had a good weekend. Yes, I did.
Great. Well, let's get started by taking a look at last week's market activity.
Yeah, we had a choppy week last week, but it did end up with, most of the major averages at new record highs. People were a little hesitant at the beginning of the week. They were kind of waiting for the Federal Reserve to see what they were going to do. They had the FOMC conclusion and surprised a little bit of the market, that they cut by half a point. The market was so surprised that it jumped up 400, 500 points. And all of a sudden, traders went, well, wait a minute, was that good or bad? Maybe the economy is slowing down too much, and that's a bad thing. And then overnight, after they reanalyzed a few things, they realized that was good for the economy and good for the market. And we followed that up on Thursday with new record highs. I think the Dow was up something like 600 points or something on Thursday, and then we had a little bit of a follow through on Friday. So the Dow Jones S&P 500 were up for the fifth time over the last 6 weeks. That was good. We also had it was a broad-based move. And part of that also was because we had better than expected economic data. We had good retail sales, industrial production was up. U.S. home builders, they liked the fact that interest rates have gone from maybe, 7.5 at the top here early summer, all the way down. I think today was like 6 1/8. So their U.S. home builders confidence went up last month. That was the first time in 5 months. So that'll be good for the economy too. That means that they're ready to build more houses, and that'll be strong. Now, the rally was led by energy, had a little bit of a bounce back in oil and crude oil stocks. Nothing great. It's hovering right around $70. Not sure, that's probably where it's going to be for a little bit. But oil closed somewhere 71.77. The sectors that led the market were energy, financial, communication services. Part of that was due to a pretty good move in Facebook last week, which was welcomed. Then we had consumer discretionary was strong due to the retail sales data, and industrial was also strong. That was despite Boeing having some problems last week with workers going on strike and all. Now, the defensive sectors that have been leading they pulled back off of their record highs. That was REITs and consumer staples and healthcare, but they're still fine. They're still up within 1 or 2 percentage points of their all-time high, so that's not a big deal. I think it was just a little bit where people that were hesitant, maybe afraid of the Federal Reserve would not cut rates too much. They were thinking, well, I want to stay defensive, and then once they got the all clear signal from Powell and company, they went back on the risk on that. So those sectors that were defensive just pulled back a little bit, nothing big. Because the yield curve steepened again. We have a normal rate yield curve again. That's 3 3/4 for the 10-year and 3.60 for the 2-year. Gold prices hit another new record high. They hit another record high again today. Part of that is rates are coming down. Usually the U.S. dollar weaken when you have lower yields and getting rate cuts. That's not happening. And the reason being is because the U.S. is still, our economy is still one of the strongest economies out there. It's stronger right now than Europe and especially Asia. And so you're seeing one of the things you can follow is UUP. And you're seeing that tick up a little bit higher. It's firmed up, in other words. But normally you would expect to see that, start to drift down as rates go lower.
Okay, and how is the technical condition of the market doing?
Okay, as far as the technical condition of the market goes, it remains fine. We're still bullish. Technical indicators all look strong. I did see some negative divergence in the 14-day RSI, not a lot. Part of that sometimes is when you have one of these V-shaped recoveries, and you'll see the 14-day RSI lagging a little bit because the V goes down and back up in a week, and the 14-day is looking at 2 weeks, so you'll see a little bit of a lag there. And that plus the fact that we were very overbought on the market. And I think that once the market kind of goes sideways a little bit here and maybe puts up some modest gains we'll see we can work off that overbought condition. You'll see the momentum indexes start to move a little bit higher. There were two things of concern I did notice. One of them was that the Dow Jones transports that had been a trading range all year, basically. It just was breaking out, and then FedEx came in and it tumbled 15% last week after missing earnings and put the Dow Jones transports back in the trading range. I'd like to see that. I'd like to see that break out of that range a little bit. So we need to get to around 16.5, I think, on the transports to have a clear sailing on that. And the other thing is that the Russell 2000 keeps bumping into this 2250 area, which has served as the top going back to July. We have had this rotation. We keep talking about out of some of the more speculative areas and into small caps. Of course, but the small caps are one of the benefactors of lower rates. And a nice sign for the market to continue to move a little bit higher would be to see the Russell 2000 go through that resistance to 2250. That would be another little feather in the hat that we'll see, a strong fourth quarter as we move on from here. Other than that, almost every sector is at a new high, within 1 or 2%. We talk about the rate sensitive sectors, the REITs up pulling back from all-time highs because we got the rate cut and people are getting a little bit more risk on. That's kind of be expected. You have REITs up over the last 90 days, almost 17.5%. Utilities are up 14.5%. It's one of those things where, as people are talking about rates going down, and you're thinking, well, okay, I guess at some point maybe we ought to look at stocks that benefit from that, and you need to look at a little bit more longer term, because I know some of these list guys you listen on TV would talk about, we don't know if the rates are going to go down or not. You want to be careful here, but again, over the last 90 days they're up double digits. And that's strong. You're also seeing dividend stocks because of the rate cuts outperforming in here too. Again, people want to find a little bit of yield as they're going into the market.
And how is the underlying market breadth doing?
We had strong market breadth last week. NYSE advanced decline line made several new highs. That's something we want to see. And you also had a nice expansion in new 52-week highs. I wrote on there last week that we had 417 new highs on Thursday. That was the most since mid-July. After that, we did see that bulls are coming back in. Retail investors had a big jump last week. They went from 39.8% the prior week up to 50.8%. That's almost 2-to-1 bulls to bears. And historically, the bulls come in around 37.5%. So they're way above range right at this stage. And then you also are getting the hedge fund managers starting to add to their positions. They're up to 87.5% now. They were down to 71.9% a week ago. So that's what's looking good right here, right now. I will say this week coming up, what we're looking at is, it's kind of not a real busy week. We do, I think, GDP coming in. Let me see here. We had the PMI composite index come in today. We have consumer confidence tomorrow. New home sales on Wednesday, the jobless claims on Thursday. We'll take a look at that. Durable goods orders come in on Thursday, GDP, pending home sales. That'll probably cause some volatility in that. But the big thing is on Friday, we get PCE. That's the Fed's preferred inflation gauge, especially. And we want to see that that's staying where it should. I think at this stage right now, they're looking for, let me get my glasses here so I can see. They're looking for the headline number to be about 2.3% year over year. That's a little bit less than we had in July. July was 2.5, so that's coming down. Now the core PCE, which is a little bit more important, they expect that to bump up to 2.7. That's up from 2.6 in July. So we'll kind of see how that comes in. We would get a surprise maybe to where both of the numbers come in a little bit hotter than expected. Then you're going to see all the analysts saying, okay, well, we've got to watch that inflation doesn't start to rear back, and then they'll start talking that maybe most will get a quarter point cut in November and or December. So that's something to watch. That should provide some fireworks next week. But I think for the remainder of this week, I think we're fine. We have earnings that'll be starting to come out here in about 2 or 3 weeks. Right now, I think once you get these rate cuts, a lot of times you'll start to see earnings tick up. And that will be something to kind of listen for over the next week or two as we finish up September here.
Oh, right. Well, after the big run up that we've been having, do you think we have any gas left in the tank?
Yeah, we do. In fact, I've read Oppenheimer and Company did a little study here going back, and since 1950, the S&P 500, September is normally a pretty kind of a bad month for the market. It's one of the worst markets. August and September are pretty ominous for for stocks. Anyway, but since 1950, the S&P 500 has hit a record high in September on 22 occasions, and in 20 of the 22, the S&P 500 followed that with a very strong fourth quarter. They didn't put what the average return on, but I would think from other people I hear out there, they're looking for the fourth quarter for maybe the market to be up another 3, 4, 5%. We'll see if we get that or not, but that would be good. I don't expect it to be clear sailing all the way up though, because I think that we're going to see some more volatility the closer we get towards the end of October going into the election. This is really a black or white type what people are looking at on the two candidates. And I think that not literally or figuratively, but there's not much gray area between what people are looking at with these two candidates, and I believe that will probably cause more volatility. One side takes the lead, you'll see the other side maybe sell, and vice versa. So that's something I would watch, but I would be buying the dips, and I think you'll see any dips will be short and sweet and move back up fairly quickly.
Great. Well, that's really cool research. I didn't know that. Also, in the weekly letter, you mentioned which sectors are strong or deteriorating. Is there anything that our subscribers can look at to stay ahead of the market and know which segment they can focus their investments on?
Yeah, we actually have just added this recently in the last month or so. Go up to the industry group on the drop down. We do sectors. There's actually 11. We only have 7. That's how new it is. They're still adding the sectors, but you can look at that, which I talk about in the weekly letter. You can see that anyway. And then we have on the industries on that drop down. We go into how many industries do we have? 60 in this one.
Let's take a look.
Okay, we have 30 industries, and these are pretty big industries. We put them in pretty wide group. Construction. They have housing construction. You have all the different kinds of that. You have different kind of financial things. And what we've done with that is we have come up with something which is kind of unique to MarketEdge, and that is we now go into segments, which I think we have 172 segments here. And this we really break down now. Go ahead and go down the page a little bit. We're going to rank these things. Go ahead and hit C. I don't. If you move a little bit to the right, we're going to rate these things. There you go. Rank them from 172, and this is going to be look at all these things. Now go back so you can see the different names on the left. So now you can see all these. You break it down. With construction. Well, here's flooring. We have drywalls. We have all kinds of stuff in these things. And in fact, click on. Let's go into. Security protection. Let's take a look at that.
Okay.
You click on the segment. Okay, now here, this one here, we only have 4 stocks on this, but this is, and some of these I've looked at, we have like 40 or 50 stocks will be in these different segments. And when you see these things, what the best way to make money in the market is to be in the right sector of the market and then find the strongest stocks in that sector that are in that industry group. And that way it's one of the best ways to make money. Now, you want to follow the trend. However, if you go in these sectors and follow these things and the segments here, you can actually, if you go and put on your list here, I always put in 5-day % move and 10-day % move, maybe year to date, 90-day % move. And that way, I can go in there maybe once a week, and I want to know which ones are now coming on here over the last week, last 2 weeks. Is there something that's all of a sudden making a big move? Maybe it's gone from 40th strongest segment up to the 20th over a 10-day period or something like that. That they don't move like that. Just you and I deciding that, hey, I think I want to own AutoZone, and maybe the auto parts might be good. That's institutional money that moves these segments like that. So what I do, I've done this for my whole career. I always want to try to be in the right section of the market, and this will help you do that. Again, I look for these segments and industries that are making the biggest move over a 10-day and maybe 90-day type of move. And if you click on, say, 10-day, go ahead and click on that in here. But let's go to a different one that has more stocks.
Okay.
Backup page. Let's go down to, I don't know, whatever you want to do. Let's go to medical labs. Let's try that. Something like that. Okay, well, this only has 6, so that's okay. But go ahead and now click on, let's say, the 10-day type of thing. Okay, now you have this RDNT, SHC. You can see these are actually, they're rated, they're bullish. The MA slopes are up. Get the MarketEdge opinion is on it, whether they've been upgraded. You have something like here that's up 10, 11% over 10 days, and MarketEdge is also upgraded the stock maybe to an early entry buy, something like that. That would tell you that one of these stocks has been out of favor, but hey, something's going on here that it's moving. And a lot of times, you wonder, you wish you knew something. This is as close to maybe having some inside information as you can get, because perhaps people, it's been leaked out that maybe some kind of deal is coming through. You look at something like this, moved up 10% over 5 or 10 days. Check out the volume. But if you go to the volume and look at that and go, wow, not only has this moved up 10%, but the volume is up double over the last week or so, and that would tell you that something has leaked out, and it's people are plowing into this thing, and you may look at the news and nothing's out yet, but somebody will know it. So this is, if you look at those two kind of things, that's probably your best chance at maybe having some insider information and seeing some of these stocks before they move. I mean, we've all looked at something that we were thinking about buying, and all of a sudden, it comes, you're thinking, boy, it's moving up a little bit. Volume looks good. Wonder what's going on. And all of a sudden they come out, they got bought out weekend, and you thought, darn, I wanted to buy that and didn't. I could have made 30% on that thing. So that's something that you get yourself familiar with that in the new industry group analysis thing. And you don't have to look at it every day, but look at it, maybe midweek, Wednesday, maybe look at it over the weekend. And maybe you might find some winners in there that haven't released any news for why they're moving like they are. But all you need to know is that, hey, technically this thing's getting upgraded, and all this other stuff is happening that makes me want to dig down and find out a little bit more about what's going on.
Okay, wow, that is extremely helpful, and I love this new section of our site. It's looking great. But
yeah, I like that. If you're setting up your performance things at the bottom there, again, I would put 5-day, 10-day, maybe probably 90-day. I would put the opinion in there. And let's see, what else would I put in it? And I also put the 50-day relative strength. That's something that you want to have in there at every list that you're looking at, because you want to buy stocks that are starting to outperform the S&P 500. You don't want to buy a stock it's not really moving much, and the 50-day relative strength is like 0.75. That means it's underperforming the S&P 500 by 25% over the last 50 days. You don't want that stock. You want to wait till it's starting to move, because it's going to have room to go. But always put that 50-day thing in there. You also want to put the power rating in there. That's going to be strong also. That means, that's kind of confirming that the stock's moving up, but there's also some technical, pieces in it that are also making it strong. So that's just a little tidbit. That's what I have on my stuff to watch.
okay, cool. Well, I just added that to my custom report as well, so I can also have that. Running out of time today. Is there anything else that you'd like to quickly add before we close out this week's episode?
No, I don't think so. Like I say, things look good, and expect some more volatile trading. One thing about Thursday's initial jobless claims, again, we're going to that's basically what the Fed is looking at right now. As long as that stays under 250, they're going to like it. But if that starts jumping up where you're up around 300 or something like that, that means that they're going to start getting worried that they may have waited too long to start cutting rates, because the jobless claims are kind of like a ship going into the dock. That's not something that you pull in there at 50 miles an hour and pull it back and make a right-hand turn and get the thing out. You've got to start putting the brakes on and moving, and you want to make before that thing gets away from you. And that's kind of what how job claims work. So they want to make sure that you don't see that thing all of a sudden start to go, because they may not. It may be a little harder to get that to come back to normal.
Okay, well, great. Thank you so much for all the helpful information, David. We do have to wrap up this week's Tech Talk Tuesday. We want to thank you to all of our listeners, and we will catch you guys next week.
All right, Carla, we'll talk to you later.